Welcome to the Pension Insurance Corporation Hot Topics Roundtable series. My name's Jonathan Stapleton, editor of Professional Pensions magazine. Joining me are panellists, Sorca Kelly-Scholte, Managing Director of Client Strategies and Research at Russell Investments, Pete Coyne, Partner at CMS Cameron McKenna, and Shah, Head of Business Origination at Pension Insurance Corporation. Welcome. Our second Hot Topics session will look at the tPR's new funding code of practice. Before we discuss this in more detail, Pete, can I ask you some questions on that, please? Does the new code of practice sort of represent a bit of a softening in the pension regulator's approach?
I think that's the $64 million question. The new code is relatively new, came into force at the end of July, so I think to some extent trustees and sponsors are still to get to grips with the new code, and dare I say perhaps even the regulator needs to get to grips with how it's going to operate the new code. That said, I think certainly in some quarters amongst employers and the employer advisor community, I think there's a general perception that the new code of practice represents perhaps a more benign funding and regulatory landscape than existed before. The counterbalance or the counter view to that would be that what this code represents is really the guidance catching up with where trustees and sponsors have already got to in their funding discussions, whether that's in relation to collaboration, whether it's looking at more flexible ways of funding. So I think the jury's still out. It's a bit early to say, but my own sense, I think, is that the regulator has talked very much about evolution rather than revolution, and I suspect that's probably where we'll end up and where we'll see the new code of practice taking us.
I mean, summing up, what are the key messages from the code?
Well, I think there are three key messages. Perhaps the most eye-catching part of the new code is the new statutory objective on the regulator, which is to minimise the adverse impact on the sustainable growth of the employer, and it's obviously one of the most important features of the new code of practice. But on that, though, I think it is important to remember that it's very much a regulator objective rather than a trustee one. So it remains to be seen quite how that new statutory objective gets played out in practice. I think the second key message coming out of the code is a pretty significant change in emphasis on deficit recovery. For the best part of 10 years now, trustees and sponsors have been very used to the concept of funding deficits being removed as quickly as the employer can reasonably afford, and that has been a feature of pretty much every actuarial valuation that I've been involved with for clients, whether that's on the trustee or the employer side. That formulation on deficit recovery has changed quite markedly in the new code, and the expectation now is that a recovery plan simply has to be appropriate, and there's at this stage very limited guidance on what appropriate will actually mean. But I think that change in the approach to deficit recovery, I think, will be an important feature of the new code. I think the third and final aspect is perhaps risk management and tPR's own approach to regulating schemes at a consultation stage of this new code development. There was something called a balanced funding outcome, the BFO, that was floated as an idea, which would sort of set parameters around intervention from the regulator's perspective. Now, that BFO hasn't found its way into the final version of the code and replaced with another three-letter acronym, which is the funding risk indicator, the FRI. The regulator deliberately has not published what the levels of that FRI will be, although has said it may do so in due course. So I think there's going to be a degree of uncertainty going forward over the next few months and potentially even years, whilst trustees and sponsors and potentially the regulator as well get to grips with what those new funding risk indicators will mean in practice.
And I think looking at that, I mean, the code is littered with references to proportionality and sort of the whole host of other ambiguities in the code as well. This, this really is about letting it settle down, isn't it, and seeing what these things actually mean in practice.
It is, and I think the regulator has been very clear that its approach in this new code is it's principles focused and it's outcomes focused, and the nature of having that regulatory focus is that you can't pin down in a code of practice what the detailed approach will be in each scheme's situation.
Thank you very much indeed, Pete. Sorca, just sort of opening this out a little bit, what's your reading of this code of practice? I mean, what are the key things that you've sort of seen in there that's interested you?
Yeah, I think you used the word softening earlier, and I think there is a softening there to take maybe some of the adversariality or potential adversariality out of trustee-sponsor negotiations. But I think the counterweight to that is, it seems to me, there's a beefing up of the need to get a good assessment of the covenant, so that it can be a balanced conversation between trustee and sponsor. I think it does reflect what's established best practice at many schemes that we see and work with, and having that integrated risk management approach to managing the scheme's funding and the contribution. And we welcome that. And the other thing I welcome is that it's sort of, to me, there's a message about it's okay to take some risk, so long as it's prudently taken and it's well managed. Because de-risking by itself won't necessarily repair deficits, and actually that's what we're all about doing. So broadly, we think it's taking us in the right direction.
Jay, would you agree?
Yes, I think broadly. I think there's an overemphasis, however, on thinking that companies prefer spreading out the recovery plan for as long as possible, and that trustees are at the opposite end of the spectrum. If you look at a company from an investor's perspective, I think investors in companies are actually now seeing through and understanding the pension scheme, the risks, the deficit, the volatility of the deficit, and everything that comes with it. And I think they're taking increasingly a more sophisticated view. It's not just about how much can I spread the recovery plan for, but they're actually saying, well, action that can be taken to reduce the volatility of the deficit, reduce the size of the deficit, and get more certainty over it, is being rewarded through an increased company valuation.
Thank you very much indeed. Thank you. I'm afraid that's all we have time for this roundtable. All that remains for me to do is thank our panellists, Sorca, Pete and Jay, and to thank you for listening in. I hope you'll join us for our next roundtable debate soon. Thank you.